And therefore, we have one of our editors in the UK with us as well, James Helliwell. Good evening to you, and good to see you.
Good evening. I hope that the electricity stays on in the meantime here in the UK. It's looking very bleak for us. Fingers crossed the internet doesn't get cut off.
Exactly. But first things first, Darius, what are your key takeaways from this FOMC meeting?
Yes, no one needs me to tell you that it was hawkish. I thought there were sort of three key things that I heard that represented incremental steps forward by the committee. So number one, the substantially more evidence in terms of their characterization of what's been happening on the inflation front from a reported data perspective. That was new. It's a transition from the clear and convincing evidence, clear and compelling evidence that they had highlighted earlier, and it sort of is an indication that the community is less, I guess, responsive to some of the sort of immaculate disinflation that we've observed in the last couple of inflation reports. Number two, he did mention, and I'm not so sure he really meant to say this, but he certainly, because he kind of backtracked a little bit, but he initially said that they were getting close to sufficiently restrictive, which is pretty interesting in the context of their prior guidance, and more importantly, in the context of sort of where these sort of annualized inflation rates are currently tracking, which are now well north or well south of the current Fed's funds rate. And then lastly, I thought the unanimity of the statement and the dot plot in terms of the lack of dispersion on next year's year-end dot was pretty telling. So it seems to be that Powell, in between the prior FOMC in early November and in this FOMC, has done a pretty courageous job of aggregating consensus amongst policymakers, which you're starting to see some of them break rank a little bit, and I expect them to be breaking rank a lot more as we progress throughout the new year. But certainly from the perspective of everything that was expected of this event today, it's very hawkish, as hawkish as it could possibly be, in my opinion.
Yeah, I tend to agree, Darius. And one of the things I noted was the increase in the unemployment forecast. I think they're aiming for 4.7 now in the base case, basically more than a percentage point higher than today, right? So pairing such an unemployment forecast with continued interest rate hikes, what does that cocktail tell you?
Well, it tells you that they want a deep recession. So a couple things on the unemployment side, right? The unemployment, if you look at the history of that time series, I think it goes back to like the 1940s or something like that. It's never gone up by 100 basis points without having a recession. Like that. So if I can figure that out, you can figure that out. James, you can figure that out. I think the 400 PhDs of the FOMC can figure that out, and they're effectively, implicitly forecasting a recession vis-a-vis the labor market, irrespective of the fact that their growth forecasts don't explicitly state that. I think they would have got a lot of pushback from the markets on that. So that's my thought on unemployment. And then also they revised up their core PCE targets, by the way. So that was pretty interesting in the context of saying, hey, look, we're going to get more sort of progress on the labor market front relative to bringing down inflation, yet it's not going to work as much as we initially anticipated. So this is a committee that's getting very concerned about a wage price spiral, particularly emanating in the services sector.
Darius, no one is better than you at breaking down inflation trends. And we obviously had the monthly inflation report out yesterday with interesting news, a clear surprise to the downside of expectations. So what are your sort of key takeaways from that report and the ramifications for the Federal Reserve outlook?
You're way too kind, man. I'm probably like the 37th ranked person on earth who can break down U.S. inflation. But I'm number one, I guess, in this show. But anyway, so I did put together a few charts as it relates to the inflation, because relative to what the committees sort of communicated today vis-a-vis Powell, I do believe that we're starting to see some significant progress on the inflation front that may morph into a very different dynamic by the time we get to the FOMC, the February 1st FOMC. So I'll start with the first chart, which is number 10. Brian, if you throw that slide up, first chart where it says mission accomplished on core inflation. Yep. So what I'm showing here in this chart, headline CPI, core CPI, headline PC inflation, and core PC inflation on a month-over-month annualized rate of change basis. And as you can see, we are now tracking at annualized rates that are significantly below the Fed's target. And so it's starting to send a signal to other market participants that, hey, look, the Fed, if they just kept the Fed funds rate here, the base effects and the progress we're already made from a sequential momentum perspective are going to drag the time series down to a significantly lower level. The next chart, we show slide 11, which is the 3-month annualized rate of change of those same four time series. And as you can see, we're not quite there yet from the perspective of core inflation. That's chart 11, Brian. We're not quite there yet from the perspective of core inflation. So on a 3-month annualized rate of change basis, core CPI and core PCE, don't forget core PCE is still lagged by a month. So this is October data. The November data are more than likely going to come down. We're not quite there yet in terms of the playing limbo, getting under that dotted red line in these charts, which is the which is the Fed funds rate. So, but again, we get December CPI in mid-January, and we get a November PCE report at the end of this month, and a December PCE report at the end of January. So we got 3 more inflation reports before the February 1st FOMC, and it's very likely, at least from the perspective of core PCE, that the 3-month annualized rates of change are actually playing limbo. It's very clear that the core CPI is going to be playing limbo by then as well. And then just 2 more quick charts on slide 13. Which is where we show all the various metrics of core inflation on a 3-month annualized rate of change basis. Because again, I don't think the year-over-year numbers tell you much at this point in the cycle, where we're trying to kind of all game we're all sort of tripping over ourselves to front run the Fed pivot. So looking at the 3-month annualized rates of change for these various measures of core, most of it's noise from my perspective, because Powell's already told us what to focus on, which is the cluster of bars on the far right, which is services CPI ex rent of shelter. And this, to me, is one of the most important data points we've received as market participants in recent months. We've had a substantial deceleration in services CPI less rent of shelter from 5.7 3-month annualized to 3.2% 3-month annualized in November. Now, Powell and the committee are very much taking the view that this is unsustainable. It's probably going to go back up. It's probably going to get back towards where wage inflation is. But I'm not so sure that that's the case, because we're starting to see significant progress on the wage front as well. If you look at private sector unemployment cost index, that's now tracking at 4.2% on a quarter-over-quarter annualized rate of change basis, and that's a 3rd quarter number. That 4.2 could easily be 3 and 2.5 by the time you get into Q1 of next year. And then lastly, the last inflation chart I'll leave you with is the next chart, slide 14, where we show these various measures of underlying inflation. Now, underlying inflation, which in my opinion is arguably the most important time series that we could be looking at in terms of trying to game the Fed reaction function: median CPI, trim mean CPI, median PCE, trim mean PCE, and then ultimately how all those things kind of feed into core PCE inflation. And with the exception of median CPI, they're now all playing limbo with respect to the Fed funds rate. And so you just roll forward in time, we're going to start to accumulate 3-month annualized rates of change and all these really key indicators that would suggest that, hey, look, the Fed, if it wants to back off, will be increasingly getting signals that they can back off. Although after today, I'm not so sure February 1st is that date.
Darius, if we look at 3-month annualized figures for U.S. inflation, we have a lot of evidence that inflation is cooling off by now. I wanted to show you a chart that I made earlier today on the entire inflation basket minus shelter, so minus housing, on a 3-month annualized basis. And that's chart 2, Brian, if you can bring that up. And it's essentially showing that we are already below zero. So prices are dropping on aggregate if we set aside housing. We can, of course, not just neglect housing. As someone texted to me, this is the so-called homeless basket or what? But in any case, it is evident that we have a different inflation picture to just 1 or 2 quarters ago. But the question I wanted to ask you in relation to these 3-month annualized charts, it basically means that we take the last 3 months and then we replay them over the next 9 months, and then we see whether we get to an inflation picture below or above target. Is it something that the Fed watches?
Yeah, so prior to today, it certainly was. I mean, all throughout the second half of this year, going back to the July FOMC, and then he really tripled down on it in the September FOMC. He said, hey, look, we care about 3-month annualized because ultimately, at least at that point in time, and it appears to be that they've shifted from this, at that point in time, there was still some expectation that they could sort of guide this and land the plane at a soft landing. I still think they'd like to have that happen, but it's increasingly clear just from their unemployment rate forecast that their willingness to have a soft landing, or their desire for a soft landing, is lower than it used to be. Obviously, they prefer a soft landing and an immaculate disinflation, which I would argue we're actually observing in the statistics. By the way, we've never seen a significant breakdown in core inflation ahead of a recession before in the history of the U.S. economy. I mean, the core inflation time series go back to the late 1950s. And so you look at all the recessions we've seen since then. There's only been one recession, and I want to say it's the 1980 recession, where inflation was like marginally sideways to down before that. Usually it's going up into and through the recession because it's a late cycle lagging indicator. So there's some interesting stuff going on in the U.S. economy that's quite historic, and I'm not so sure that the Fed, which is very clearly anchoring on historical relationships between the labor market and its core services inflation, may not be necessarily picking up on that. But I do believe at some point in the early part of 2023 that they will pivot towards picking up on it relative to how we ended today.
If we look at the US inflation data, it seems like we have compelling evidence of a slowdown in the sort of pace of price hikes. But is this a global phenomenon by now, Darius?
Yeah. So that's a loaded question because we got my friend James here as well. But we got Bank of England and the ECB meetings, among other meetings, tomorrow. And from my perspective, what we've seen across all these economies is a significant breakdown in core and really in headline and core inflation pressure on a sequential basis in the most recent month. And not only was that the sequential significant breakdown, we're also seeing significant breakdowns relative to expectations as well. So it's very clear that across the developed world, we're seeing, again, I hate to use this, we keep using this phrase, but there is an immaculate disinflation going on at the current moment, and that, in my opinion, lends some credence to the transitory camp, right? I've always said, going back to the earlier part of this year on the program, I said both camps are going to be proven right in this cycle, most likely. Persistent camp from April 2021 through, let's call it, early October 2022. And then you might have the transitory camp get proven right for a brief window of time before we all puke into a recession at some point in the second half of next year, in our opinion. So I'll turn it over to James for some more detailed thoughts on the UK.
Yes, I mean, since we are a global company at Real Vision, we obviously have boots on the ground right around the globe. And James, we have with us from the UK. I wanted to get your take on the inflation numbers out of the UK today. They also decelerated relative to last month. So take us through your thoughts on the inflation pressures in the UK and Europe.
Yeah, they did. That's right, Andreas. And I think Darius made some good points about the pace, not only the headline pace slowing, but also when you went through the breakdown, ex-housing as well, basically everything else softening. But I think the story in the UK, it shares some similarities in the most recent print, but I think the bigger picture is one where the risks are still, I think, skewed to the upside. So one of the things that, Andreas, I know we were chatting about a little bit earlier off camera was how clearly the energy situation in Europe is more unique to the region compared to what's going on in the States. So we, as Europeans, remain vulnerable to energy prices, more so perhaps than our friends in the States. So that's one of the key differences. Now, when we took a look at the this morning's report on UK inflation, it showed that the basket of about 12 different factors, it actually did show breadth of deceleration. So 6 out of the 12 categories were in fact slowing. So it isn't just, or the optimists would point to the fact that it isn't just petrol prices or gas prices that came down, being the only reason for the downtick, but one of the most stubborn components of food prices, after shelter, which we consider, of course, in every equation, food prices accelerated further, and they're increasing at about the fastest rate that we've seen in decades. So that remains an issue, and no amount of rate hikes is going to make the price of wheat or anything else cheaper, right? So that's very, very sticky and very difficult to get in order. The other thing to point out in terms of the current situation and some anecdotal evidence of what's happening quite literally on your front doorstep here in the UK at the moment, aside from the weather where it's very cold suddenly across Europe, which clearly plays into the energy crisis and concerns there, sudden cold snap, are all of the people who are on strike at the moment. So beginning with postal workers for the next couple of days, so Royal Mail, nobody's delivering letters, or fewer people are delivering letters and post at this time of year. We've got nurses for the National Health Service going on strike for the first time ever, I believe, That's how desperate things have become from tomorrow. And that's joining, who else have we got? Rail workers, not surprisingly. They're always on strike here in the UK, and a bunch of other sectors as well. So the traditional unionised stuff as well. So it's almost reminiscent of the winter of discontent in some ways. But the key thing to focus on in terms of today's print and this month's CPI data is that, yes, whilst it ticked down from 11.1 to 10.7%. It's still double digits and still compounding at a higher rate, even if the Bank of England does see its target rate, so its target rate still being 2%, but its estimated rate of 4% inflation realised by the end of 2023, so in a year's time. It's still not deflation. So the cost of living is already at a critical point, maybe a breaking point for some people who, there are still too many citizens who are now resorting to food banks and things like that, which seems crazy in this kind of country. But we're shackled ultimately by wage inflation or wage demands. With the strikes that are going on, Jeremy Hunt has said that he's going to stay firm and the country needs to take some pain, and in other words, not tolerate or bow to those wage demands, as they'll only contribute to inflation longer term. Whether or not it capitulates remains to be seen, but it does appear as though the messaging, at least for now, is clear in the government and the Bank of England preparing us for a recession. So ultimately, the hard medicine or the bitter pill to swallow being the only way out of this. Now, a couple of other unique things that I want to highlight here from the perspective of the UK is that ultimately it is, to some extent, Brexit coming back to bite us on the backside. So clearly, if there are labour shortages, as there are in the US as well, reportedly, as well as the UK, depending on whose opinion you read, into another thing that we're being beaten up by now is basically a lack of migrant workers, arguably. So the supply of labour when the labour market is tight to work in the services sectors, typically lower paid jobs like cafes, bars, restaurants, whatever it may be, is driving inflation. So if you've got food prices and higher wages still problematic, even if the price at the pump, fuel has come off, oil's pretty much flat year over year, it's driving. You can see it showing up in the insolvencies now. So the bankruptcies in the UK are spiking, not surprisingly. They're on something of a surge, and it's generally the smaller businesses who are unable to tolerate the slowdown in demand, but more significantly, the rise in food prices and so input costs and also wages. So there doesn't appear to be a resolution to that in sight. If anything, it's, at least on the wage front, only likely to get worse. And there isn't a solution of, say, well, let's have more migrant workers come in all of a sudden, because politically that's not really something which we can resort to for decisions that have been made in the past. I think just lastly there, the other point to make is that similarly with supply chains and simply, so that's sort of the services inflation, but on the goods side, it's again very difficult to get the flow of goods through the ports, particularly at this time of year. Again, for the reasons that have been mentioned around leaving the EU and things like that. So, yeah, I think in essence, the terminal rate of 4.5%, with the Bank of England currently at 3% and expected to hike 50 basis points, as we saw the Fed do today, in tomorrow's meeting, taking us up to 3.5. I still feel that that terminal rate is optimistic. It's on the low side of things. Clearly, the Fed is already there now at 4.5%. In the UK and perhaps other parts of Europe, I still see there's upside risk to inflation. I'm not sure that we may have seen the high print, but I don't think that we're going to see this transfer argument. I know that our views may differ there slightly, Andreas, and that's obviously an interesting topic for debate. But I think where we are aligned is in seeing the risks of ultimately the energy shock come back to haunt us in Europe as we had earlier in the year. And one of the key things that's my concern there, and slightly cynical view, is how China's reopening or abandonment of COVID-0 has coincided with the cold snap that we're having across winter, all of a sudden, literally to the week. and how it's pretty convenient for the likes of Russia, who have, obviously an interest in oil and other hard assets there. There seems to be perhaps an economic war taking place rather than a literal war, at least as it relates to China and the West, where of course the situation in Ukraine is ongoing. That's basically where I'm at. And the last little piece that I've picked up today, I read a headline. So in terms of like bracing for recession, I just sold my place. I'll be moving out of here in a couple of weeks, set up a new beautiful studio somewhere else. But I just sold my house, worrying what's going to happen in the next year or two. And I was at a stage where I wanted to move. I was expecting house prices to come off. Or I am expecting house prices to come off in the next year. Just to wrap things up, we've got Jeremy Hunt and other people in the government telling us to brace for a recession, essentially. We've also got Bank of England telling us, Andrew Bailey telling us today that a 20% decline in house prices could be tolerated by the British public. Now, if that isn't positioning you, right, or leading you down a path to accept a 20% decline in your equity, good Lord, what on earth do they have in mind in terms of the bad scenario they're trying to prepare us for? If 20% is seen as, don't worry about that, you'll be fine. Good Lord. So it's looking scary. But I think to conclude in short, it was a downtick. Petrol was a key driver of that. Whilst there were other factors as well. I think more broadly, we're very vulnerable still to an energy price shock. And I think amongst other things, and I don't see wages and food inflation necessarily being resolved by rate hikes or anything that we can necessarily influence in terms of policy here in the UK anytime soon, and we remain vulnerable and exposed to those ultimately. So maybe those energy blackouts are going to be coming in January and February, and fingers crossed I'll have internet for these live streams at 9 p.m. UK time.
We will find our diesel generators for the Real Vision daily briefing in case. But in any case, James, it was a great overview, and we are blessed to have you with us, since you're apparently the only one not being on strike in the UK right now, if I understood you correctly. But James, I wanted to ask you one thing before I leave you for the show. Bank of England, every time they hike interest rates, seen from abroad, seen from European soil in my case, it sounds like they almost dislike doing it. So what do you make of the rhetoric within the Bank of England around these rate hikes?
I think that's just British culture. I think we sound awkward no matter what we're talking about, as I do. No, I wouldn't read too much into it. I think ultimately the big picture is that, at least from my perspective, is that they talk to fairly low or conservative terminal rate. That to me, it still sounds far too low. And ultimately, I think they're just trying to be politically sensitive or approach things slowly. Whereas on the other hand, that sort of balance isn't being found, it's been offset by the pretty blunt, steadfast rhetoric that's coming from the likes of Jeremy Hunt, where saying, no, we're not going to meet your wage demands. You're going to have to take pain. It's for the best. So enjoy the recession and enjoy sitting in the dark. So no, that's been a little bit facetious, but I wouldn't read too much into it. I personally feel that rates have probably got a lot further to go, as inflation has.
Bank of England was obviously one of the central banks very involved in bond market liquidity. And since we have a liquidity expert with us today, Darius, I wanted to get back to you and the dollar liquidity outlook, because I tend to think that we don't talk enough about the balance sheet of the Federal Reserve. We tend to focus all our energy on the potential pivot on the Fed funds rate. But what about the balance sheet? Let's assume we get a pivot during the first half of next year, or at least a pause. Will the balance sheet contraction end with the same timing?
Yeah, so that in my opinion is the real wild card as it relates to risk taking in the first half of next year. So let me set the stage before we even unpack the kind of net liquidity dynamics that I think you have. By the way, you did a fantastic job on your the macro trading floor this past Sunday with Yuri and Timber on the balance sheet. So everyone go check that out, because that was a really good discussion. Before we even get into liquidity, I think it's important to kind of set the stage for where consensus is heading into next year. I mean, so if you look at any Wall Street strategist, and I was literally laughing in my hotel room on Friday, like they listed every like major sell side bank, and I'm not kidding, to a man, woman, and child, everyone had a more or less kind of flat to up price target, but everyone thought we'd crash in the first part of the year, and then the Fed would pivot, and we'd price in the recession, and we'd rally substantially into the second half of the year. So that's consensus on the sell side. We know what consensus is on the buy side. Buy side is still very much net short risk parity, short treasuries across the curve, short stocks. The euro is one of the things that are standing out with respect to that long bias, but most foreign currency still very much net short as well. So that's the positioning setup. If you think about trying to take risks, and then the liquidity setup, very much it's unlikely that the Fed ends balance sheet contraction anytime soon with respect to its quantitative easing program. That's probably going to run through at least year end. Now, does that really matter? I would argue no. If you look at Q4 to date, in terms of how we calculate net liquidity at 42 macro, which is the Fed's balance sheet minus the Treasury general account balance, which when that rises, it drains liquidity from the system, and vice versa, minus from those two factors, minus the reverse repo facility balance for the same reason. We've seen both independently the Treasury general account balance decline Q4 to date and the reverse repo facility balance decline Q4 to date overwhelmed quantitative tightening. And so I think it's somewhere around 179 billion of QT thus far recorded, somewhere around 250, 270 billion of TGA drain and RRP drain respectively. TGA drain is probably not going to continue. We're currently around 375 billion. Right now, Yellen is targeting, or at least per the now faulty November quarterly refunding announcement, they were targeting 500 billion in the TGA, Treasury General Account balance, by the end of March of 2023. So that's about 125 billion from where we are today. So if you linearly smooth that out, you're probably going to get somewhere around, let's call it, 25 to 35 billion dollars of TGA build into the March of next year. So that's negative. That's an additional headwind for risk assets is vis-a-vis the quantitative tightening program. The big wild card, as you and I both, I think, agree on, is this massive 2.1 or 2.2 trillion dollar balance or somewhere thereabouts in the reverse repo facility balance. That thing is de facto QE waiting to be unleashed upon global financial markets whenever the market has confidence that the Fed is, according to Jay Powell's statement today, has received substantially more evidence in disinflation. Now, based on the statement today, I do believe that window of time between them achieving substantially more evidence actually got a little bit wider. So heading into today, I would have thought that I thought there was a reasonably high probability based on what we expect to see over the next couple of inflation reports that this could be the last rate hike of the cycle. I'm now very much of the view that they're probably still going to hike in February no matter what the inflation data says, but that could very much again be the last rate hike of the cycle. And you got $2.2 trillion of more or less unconstrained excess liquidity sitting there that's ready to capitalize global financial markets. And it's very clear that the dollar, which is clearly breaking down from a quantitative perspective, would easily get destroyed on that. And obviously that's very positive for risk.
Yeah. One thing I could add in terms of the Treasury general account is that we have the debt ceiling looming in 2023. And usually the US Treasury is not willing to incentivize politicians to negotiate forever, which means that they bring the TGA down ahead of such a deadline to ensure that they reach a conclusion on the debt ceiling. So that's at least something to watch. It will add liquidity if they continue to bring down the level of this Treasury general account into the early parts of next year. Let's move to some questions from the audience, Darius, because we obviously have a ton of them coming in, given that it's the Fed day. So first of all, we have a question from a trader on Twitter asking you whether it is possible that the Fed may have to raise its inflation target from the 2% to even 3 or 4% as a consequence of this inflation discussion we've had.
So we've been on the tape all year.
And talked about this, haven't we?
James, my apologies.
Sorry, Darius. No, we've heard. I'm sure I've heard them talk about it. So I'm getting mixed up with the UK. They began talking about 4%. I can't remember if it was the BOE or the Fed. Like last week, one of them began talking in terms of 4%. So they've unofficially abandoned it already in their minds. Whoever it was, BOE or Fed, they've already started letting go of the target, walking it back. What do you reckon, Darius?
Yeah, so we've been on the tape with this more or less all year, saying that they may and they will eventually abandon their inflation target. the 2% inflation target. I mean, they've already abandoned it, right? Going back to the fall of the summer of 2020, when they swapped 2% for an average inflation target of 2%. So that was a de facto increase in the inflation target. That was one of the features of what caused us to get to this point today. They don't have the political cover based on that experience to change their inflation target, nor is the bond market currently anticipating them to change their inflation target. If you look at term premia, you look at inflation and swap rates. In fact, I have a chart, Brian, if you look at slide 35, where we show the 1 year forward and 2 year, 1 year forward break even and inflation swap rates, and they're all coalescing around 2.5%. And so this is the bond market effectively saying, or the inflation market effectively saying, hey, look, we're already at the upper boundary of what we would consider to be a 2% average inflation target. So now if you so there's not really much wiggle room from that perspective for them to do that anytime soon. But we've talked about our secular inflation model at various points throughout the year, and that model in terms of projecting the sort of the underlying mean of core PCE, it's saying, hey, on the high end of our estimate range, which is 2.3 to 2.9%, we could actually have double the amount of core PCE inflation over the next 10 years that we've had in the trailing 10 years. And so, if the Fed is trying for 2, the market thinks 2.5, and our model is saying 3, more or less, there's going to be a day of reckoning where we have to understand that, hey, is the Fed really willing to sacrifice millions more jobs than would otherwise be necessary to go from, let's say, 3 to 2? Or will they just, at some point in time, let's say in some mid 2024, have a review, which he kind of tipped the hat to, where they do kind of raise that thing to 3. I think they're going to. I just don't think there's going to be a linear process.
Guys, I like a bit of banter, and we've received a comment from George on YouTube. He's saying, isn't it possible that Jay Powell produces so much gas that it will solve the EU energy crisis by itself? And I guess the answer to that question is yes. But the final serious question of the day is from a guy called Cashflow on YouTube. He's asking you, Darius, with wage growth running as high as now, isn't it unreasonable to expect sort of a Goldilocks view of inflation decreasing with growth increasing or staying flat from current levels?
Yeah, by the way, Cashflow is a phenomenal Twitter name. I should quit finance and start rapping. Anyway, yes, it's extremely unreasonable. As I mentioned earlier at the beginning of the program, we've never seen core inflation break down as materially as it already has on a sequential basis prior to a recession. You need a recession to cause the sort of animal spirits in the economy and the wage price spiral dynamics to sort of ease in a way, the labor market to ease in a way to really get core inflation down. But we are observing it in the data. It's happening. There's no ifs, ands, and buts about it. You have charts on it. I have charts on it. And so we have to accept the fact that, hey, look, as unprecedented as everything we've seen in the last 2.5 years has been, we have to now continue to believe that, hey, there might be some other unprecedented dynamics. And this is the benefit of having a data-driven process, right? I mean, if you just took the view that, hey, look, there's one view that, I continue to push back on, just to use it as an example. There's been this view that, hey, look, the economy's about to go into recession, about to go into recession. But if you took that view, I don't know, probably 6 months in June, 6 months ago, when that view really took the forefront, you've lost money on the things you would have bought, bonds, et cetera, most importantly, on taking those views. So I think it's really important that we humble ourselves as investors. If most of us have been humbled at various points this year in the market. I certainly have. I think I'm down 360 basis points here to date. Which is not something to write home about. We've all been humbled by the market this year. So I believe it's very important to maintain that kind of integrity with respect to being data driven, because again, there's a lot of, for lack of a better word, stuff happening that is not normal.
Final question from our member Paul, and I don't know whether I dare to throw this question at you, Darius, even though you can answer almost everything, but it's
not well.
He writes, closing question for Andreas the Meme Steno, Darius the Skipper Dale, and English James of Helliwell. Who will win the World Cup, Argentina or France? Darius, you first.
Seattle Seahawks.
James. I'll tell you what, Leeds United won't win it. My team.
I'll go with
England
France.
Yeah, probably. Everybody wants. Well, I think I speak for everybody where they want to see Messi lift that trophy before he bows out, given that Ronaldo's missed out on it. But It'd be iconic. Even as an Englishman, I can say that the Argentinians. That's love.
I'm born and raised as a Real Madrid fan, so I cannot concur with that view. I think we will leave it at that for the soccer chat for this edition of the Real Vision Daily Briefing. I'd like to sum up a bit. It seems as if we have more compelling evidence from the US of slowing inflation relative to the UK and the Eurozone, which is an interesting divergence also reflected currently in a higher Euro versus US dollar reading. So essentially, when inflation continues to print at high levels in Europe relative to the US, it makes sense to chase a story of higher interest rates in Europe relative to the US. And today's takeaways from the FOMC is still a very hawkish Federal Reserve, despite the softening that we've seen in inflation recently. First of all, Darius, always a great pleasure to host you, and thank you again for being with us today.
Appreciate you, man. Andreas, James, man, it's an excellent conversation. And if I can just leave everyone one quick thing, humility is key. I mean, this is we could very well be in the middle of a phase transition in terms of asset markets, and probably not just given what happened today. But I think it's very important to just be flexible, be water, don't get wed to your views, particularly in these particular moments, because that's when you lose the most money as an investor. So that's my 2 cents.
For sure. Take a good break over the holidays, recharge, because you need to have a fresh mind to be flexible. If we're entrenched still in what we've been through, it's setting up for a bit of a mess in the new year.
Mm-hmm. That's great advice, James. Thank you.
We have one thing left, and that is the meme of the day. I've used it before, but I still love it. I'm going to hike interest rates until you morons stop trading monkey JPEGs. Kind regards, Jay Powell. I will leave you with those words for today. I'll be back with my friend Tommy Thornton tomorrow, so see you there. Thank you for watching today.